This week I'm going to show you the UK stocks I bought, the top riser and the top faller in the portfolio, and as always the share tip of the week, which is a high risk, high reward dividend growth stock. And if you find this video useful or simply enjoy it, please drop me one of these to support the channel, as it's much appreciated. According to Google Finance, the FTSE 100 is up by 2.89%, the FTSE 250 is up by 3.58%, and the S&P 500 is currently open whilst recording. However, the last time I looked at the data, it was up by 1.56% for the week. My portfolio, however, is only up 2.55%. which means this week I actually underperformed the UK markets. And I'm going to be making some adjustments to the portfolio, which I will be talking about later in the video. However, if you'd like to ask me any questions about this, then you're welcome to come join the Discord, which I will be active today from 3 till 5 PM. And you can ask whatever questions you'd like according to strategy, or you can also reach out to other members in the community. Link is in the description down below. Starting the top topics of the week, we have EasyJet. They've recently announced that they've decided that they're going to make their customers pay for the overhead luggage bags, which is quite an interesting move. It's something that I personally don't mind. I understand the idea behind it, right? So there's going to be ideally less weight on the plane, less fuel costs, but they've stated that it will help being more punctual. So the idea is that if there aren't people putting bags up there, it means they'll be able to start the flight and end the flight quicker, therefore meaning that over the longer period of time, like a year, they will get more flights in and out, which would then mean slightly more money. Although, if they have no customers, how are they going to make money? But seriously though, I don't mind, as I'm someone who packs really minimal when travelling, and so if there's an option to go with EasyJet, and perhaps it's just an uncomfortable flight until Europe, but you're paying less and you don't need to pack that much luggage anyway, then why not take the cheaper flight to the same location, not fright. I don't know why I said that. Next, we have the supermarket sector, and this was actually spurred on by Tesco and Morrison's on Wednesday. They decided that they were going to pay back the tax relief for the pandemic, which in turn would effectively be repaying the government. Well, this had really shown like how much of an oligopoly the supermarket structure is, as the moment that Tesco had done this, Morrison's had followed, and then I believe B&M, Asda and Aldi have all followed suit. I believe there are a few more, and it really goes to show that it really is such close-knit and they don't have that much individual power, as it's very likely those that don't take back the money will have to provide some excuse or they will be frowned upon. And what I think is this is a really clever move by Tesco. This is because they're disposing of their Asian assets. So they're going to be getting a lot of capital or cash. Then this money could be just, so they could then use, because they have a better financial position than likely all of their peers at the moment, they could then say, right, yeah, we're okay, let's pay this money back to the government. And then it kind of forces the other supermarkets in the industry to also do the same thing, basically being a micro win for the Tesco. And I've got to give credit for it, but I'm still not interested in it as an investment. Last week I had spoken about Arcadia and their potential collapse, and that had happened this week. But this week I'd like to talk about Associated British Foods, which is the parent company of Primark. Now, despite the lockdowns and the pandemic really decreasing footfall for high street stores, Primark have actually said that they expect an increase in profits for this year than it was last year, which is truly quite incredible, and it shows how resilient this business truly is. In the past, I had made a mistake, and I genuinely thought that Primark had an online store, as they have the infrastructure and the products, but apparently when you go onto their online whatever it is, it goes to a point where you have to click onto the products, you can see the price, but it's then locate it in store, which honestly is quite baffling, because surely they've got most of the hard bit out of the way. As long as they have a payment solution and some way of doing deliveries, which is probably very complex, then they would have access to online and they'd be fine. But regardless, what I have noticed is that they have got a lot of brand loyalty, and there's people queued out of many Primarks across the UK, and it really shows how resilient of a business this is, even though they had been closed for the last month. And this actually may be an advantage that they are retail or high street only. And you may think, well, what about Boohoo, ASOS? They're just going to dominate them and eventually they're going to disappear. Maybe, But what Primark has is they've got a better financial position than most of their high street competitors. So they'll likely be probably one of the last standing high street fashion outlets. And therefore, I think that's quite a strong position to be in, because I still believe that the convenience of being able to try on the products in store, even if that has been halted due to the pandemic, is something that can outweigh the benefits of ordering online. And so I definitely think there's still a place for Primark in the economy, and I'm interested to watch it as an investor of Boohoo. And actually, I'd like to talk about Boohoo right now. And that's because there's been a lot of speculation, and this had happened at the start of last week, start of this week. The idea was that since Arcadia could potentially collapse, that Boohoo will be coming in and they'll be buying up some of the brands. And yeah, I think this could be a really strong move for the company if they purchase a label. So let's say they purchase Topshop and Topman. If they buy the brand names but not the assets like the high street stores, then likely they'll be off to a winner because they can use that brand as part of divide and conquer and therefore have a larger customer base and more options for growth. However, this had meant that on Monday morning shares were up over 6% just because there was speculation that they may buy it, which at the time I thought was pretty ridiculous, and so naturally I went to Twitter and had a cry about it, because that always solves the problems. Anyway, whilst I have discussed the idea that Boohoo could benefit from purchasing some of Arcadia's brands, I don't think this should really let the share price go up. And obviously, I'm not Mr. Market Maker Foreman. I'm not just going to control the markets. But they still have some serious issues that they need to continue getting beyond. The idea that they still have serious governance concerns. Obviously, it was pointed out a few years ago about the PLT acquisition. Whilst yes, they have got phenomenal growth, that apparently the chairman's son was actually just being managed by the chairman himself, and then they delayed the purchase of PLT to therefore allow for additional money to be withdrawn out of the business and into the family. I'm not going to get into that complex process, but they have shown that there is some governance issues. Shadowfall is still short. The company is still without an auditor, and that's quite serious. And whilst yes, I do think that if at any moment, even if it's next week, if we get an auditor, then yeah, the share price will likely unlock and go up. At the moment, if there's no auditor and the share price had rallied to 320 pence at the start of the week, I think it's just a disaster waiting to happen. Whilst I remain long on Boohoo, meaning that I am bullish on them over the long term and will continue to hold for that time period, and that they have excellent growth potential in the US, which is only 1/5 of their market size in the UK, yet at like a 10 times bigger economy. So there's a lot of potential there. I still think that we should be quite patient and not focus on the short-term noise. As if you end up getting caught up on it, you could just end up getting overexcited or the opposite and really disappointed and then panic selling when it's dropping. I will personally be topping up if we see a significant share price weakness. A lot of people have reached out to me saying that they see Boohoo at certain share prices by the end of the year. And honestly, I don't think that's a method of thinking, especially as a long-term investor. Regardless, I will be topping up if it drops below 270 pence per share. Very likely that I will be buying more and adding to my existing position. Despite the high allocation, I'll explain more of this later, but I see a lot more short-term value at that point, and it's pretty consistent money if you buy in beneath that price. And this is because in January, historically, they have provided a trading update, and you've got Black Friday, which had apparently been the best ever before, and also the fact that we've got Christmas, which is either going to be good or it's going to be bad, but the idea is that that's likely a lot of potential revenue and earnings growth that could really send the share price up, especially when combined with saying they've got a new auditor. So I'm quite interested in building up these positions as much as I can in the short term, so that over the long term I can benefit from where I see it in 3 to 5 years time, for example. The top riser in the portfolio this week was the London Stock Exchange Group, which was quite a pleasant subscribe. Oh, you should totally do that. I didn't actually mean to do that. Quite a pleasant surprise. There we are. I choked. I'm not even going to edit it. That's how legit it was. The shares were over 9% up for this week, and this is because there was a report that says that they are set for the Refinitiv acquisition. It's very likely that the European Commission would allow this process, and therefore things are looking more optimistic with the share price of LSE. There will be an outcome to this on the 21st of January. So it's either going to be good or it's going to be bad, but the European Commission has declined to comment. So things could still go either way, but it's a nice sentiment boost. Not so great as I would like to get more shares in the company, but I won't complain. The top faller this week was actually Softcat, and it's not really a surprise. They've been underperforming for like the last month and a half at least. And to be honest, that's really starting to impact my own personal investor sentiment. I'm not saying, oh, the share price being down consistently is a serious negative and that I just can't handle losses, and perhaps I'm being biased to myself and I can't even see that truth. But I don't think it's the case. Shares are only down 0.79%, but I do have some more concerns with the business that perhaps I didn't have when I initially invested. And there's a few reasons for this and a personal strategy change that I'm going to implement over the short to medium term. One of you had reached out to me, and I'm sorry, but I've forgotten who it was, and that's because it was very much over the last few months, and there's no way I can find that comment. But basically, the gist of the comment had suggested that I don't understand why you purchase these dividend growth stocks if they just sacrifice that additional revenue and earnings growth at the sacrifice of a higher dividend growth or yield. And it really made me think about it, because it's a really true point. I like the idea of having dividend income, but if I'm just sacrificing potential revenue and earnings growth, it's not really an advantage, is it? I'm just, at the end of the day, just sacrificing some capital appreciation for a little bit of dividend income. And then furthermore, on top of this, Softcat is my only holding in the whole portfolio that doesn't have a substantial moat. Initially, I had bought them, and the idea was that over the longer term period that I would hold them, that they would start to build out their product offering and range, therefore have a larger customer base, and from that they would build a substantial moat. But I realise now that that likely wasn't a good idea, because the industry doesn't have high barriers to entry. Anyone could really start their own sales business in their garage, and funny enough, I'm pretty sure that's how Softcat started, but that's off the top of my head. Regardless, that means that it doesn't really put them in a very secure position, and whilst they have been a fantastic company over the last 27 years that they have existed, I don't think it's really worth the investment, especially if you look at their competitors, like Kainos, for example. And I think this is a personal mistake I had made. That's because I saw them as a technology stock, so I thought naturally, or I had a bias thinking technology stocks, they're resilient, they can weather the pandemic, and that won't be an issue. But in reality, they're not just a technology stock, but rather just a sales business that doesn't benefit from it does from their product offering, but it's effectively their revenue and earnings growth is completely based on the quality of their sales team. And that's not really something that I'd like to see, where you could add more organic value to the products that you're offering and therefore sell more of them. Before talking about the stocks I bought this week, I'd like to reveal my personal strategy change in hopes that I embrace the transparency that I like to commit to on the channel, but also perhaps provoke some knowledge. Even the idea that I'm recording this to a camera, it allows myself to think more upon the idea, but then also if you have any opinions of it, you can always leave a comment down below, and there's always been such incredibly valuable comments that you guys have left. After all, I can't believe we're at 2,500 subscribers. Okay, that's quite a bold assumption, as at the moment I believe it's 2,490, but I think by Sunday it's very likely, and I can't believe how quick it has been. It's been 8 months from zero to that, and we've got this awesome community that likes to talk about UK investing in stocks. And I ramble on a bit there, but I'd just like to say thank you for that. But I would like to talk about this strategy change, and hopefully we can get some good information out of it, or we could just watch me be a clown. So either way, I think that's a win-win. In hindsight, if we look at the portfolio, I'm relying very heavily on 2 growth stocks. And by all means, these are 2 excellent companies, in my personal opinion. We've got Boohoo, which takes up a 50% allocation, and Games Workshop that takes up a 25% allocation. This means that my entire investment portfolio is taken up by 2 stocks that take up, I did the maths wrong, they take up 75%. I just spat about 3 times the last 2 minutes. I'm sorry, I'm getting really distracted. Besides the point, the fact that there's 2 stocks that take up that much, I don't think I'm adequately diversified, and this was backed up when the vaccine news was announced. All of my holdings except one, which was Ashted Group, had actually declined, and by quite significant amounts of that, at around about a 10% correction. Because I wasn't adequately diversified, I began to underperform the markets. Obviously, you could say on the flip side that I could outperform the markets, but I don't think I am adequately diversified, which goes to my point. Boohoo and Games Workshop, they are both retailers. Whilst Boohoo is online only, Games Workshop had really resilient and impressive performance this year because of their online retailing. I don't think there's much diversification between the two. Then if we look at Softcat, which is based on their online product offering, which they sell to their customers in order to upgrade their infrastructure, that gives me a lot, and I mean a big allocation, I think around 83% of the portfolio in online sales. And that's really not diversification in my own personal opinion. And in the short to medium term, I don't plan on changing my high allocations, such as that 75% that I'd mentioned, to these growth stocks, but rather build up the other positions that aren't Boohoo and Games Workshop so that those allocations slowly drop down in line with my deposits. At the moment, Softcat are definitely the closest to the chopping block, and I'm no longer holding Softcat as a long-term investment, but rather I'm going to be deciding what I do after their AGM or annual general meeting on December 10th. I'm going to make a decision, and I will do this because after that period, there will not be a trading update till March, and I suspect that investor sentiment is likely going to remain low if the outcome of the AGM isn't great, and therefore the idea is that I will be happy to just cut my losses and put the money elsewhere because that's a significant opportunity cost. And I feel that that money could be better placed elsewhere in the portfolio for a better return or a more consistent return over the longer term. Then, once I've made my decision on that, I'm going to be building up my FTSE 100 stocks. I've said before the FTSE 100 isn't a good index, and I still agree with that. However, what I can argue is that these businesses, the ones from the FTSE 100 that I have in my portfolio, are well diversified, strong businesses that really are very consistent at bringing in growth and earnings. So these stocks such as LSE, HLMA and Ashted Group or AHT, these I plan to have an allocation of between 10 to 15%. All of these stocks, with the exception of Ashted Group, are underweight. London Stock Exchange, I believe, is 4.4% and Hallman is 3.9%. The idea is that these companies will be the core of the portfolio. Yeah, they won't take up more than 50%, but I think it's the core that's resilient and very good businesses that I know that over the longer term, they will be okay and they will be performing well. Whereas then I would like to replace the remaining part of the portfolio, which will likely be around 60%. And I would like to put that into more high growth stocks, such as your Boohoo and Games Workshop. There you also have a third stock, which I would be planning to add, although the catch is, I don't know what it will be. And obviously, if I lose this sentiment or I've lost the sentiment with Softcat, it really depends on what they say in that AGM. If I decide to sell this, then I could be looking for another stock that could be a growth stock to add to the portfolio. So then I would ideally have more of a balance between Boohoo, Games Workshop, and then that third growth stock. Therefore, they could all consistently, hopefully, bring in more longer term returns and not just have my whole portfolio based on Boohoo. And if Boohoo does bad, my whole portfolio just drops. It's likely that I will hold on to Softcat until this negative trend reverses, but as I said, I'm not afraid to cut my losses if I just no longer agree with the business and their model. And if you sign up to Trading 212, you can get a free share worth up to £100 when you deposit just £1 using my link in the description down below. This week, I think there's substantially a lot less value in the markets, and therefore I figured, you know what, I might as well buy into the more premium stocks in the portfolio. And I'd started by buying a share of LSE, making my total position size from 7 to 8 shares. Not a massive change, although I'm just doing consistent weekly deposits at the moment. As simply put, I do not trust my industry where I work, and therefore my main priority is rebuilding that emergency fund, and it's getting there slowly. These 8 shares have an average price of £81.42, which is about £3 per share less than it was about 3 months ago, as I did sell more than half my position. And it's very likely that I will try to get more equity in LSE prior to the Refinitiv acquisition. So before the end of January is where I'd really like to just build this position up a little bit more. The next stock I had bought was Hallman. This is a stock that I've been wanting to buy for quite a while, but I just put it off. They'd just been valued elsewhere, and now they've had quite a significant correction of over 10%, and this is a low volatility stock. And I think this is in a really good price range where I would like to continue topping up. Furthermore, I decided that I wasn't really re-looking over my company's financial positions. I would buy the stock, look at the financials prior to it and think, yeah, they're great, and then I would forget. And that was probably one of the reasons why I lose sentiment quite easily. So what I decided to do is look back through these stocks like Ashtead Group, LSE, Hallman, and I looked at Hallman and I really saw how resilient and how well they are at generating revenue growth, although at the moment not as much. But I really think that in the future is something I would like to have a bigger slice of in my portfolio. Whilst this week I only bought 2 more shares, I very much plan to build this position up before the end of the year, as I'm actually a lot more bullish on it than I have in allocation to my portfolio. They're also at their February levels, which is prior to the pandemic crash. And a lot of people say, well, if they're at their February levels, that means they're too high and it's going to drop. Well, this is a premium stock and they were trading up around £26 a share literally last month. And now they're trading at around £22.50 per share. The share tip of the week is a high risk, potentially high reward dividend growth stock that has had a history of fantastic dividend growth. There are a few risks involved with this investment, however, and that's led to the share price decreasing consistently over the last week or so by double digits. Their revenue, earnings, and free cash flow have all gone on a serious negative decline, and at the moment their profit margins are at 1% compared to 6.4% in the last half of the financial year. And that is definitely a concern for alarm, an alarm for concern, as it seriously, if it continues, they may become unprofitable, then that dividend's unsustainable and ultimately they could seriously struggle. On the other hand, they do have a really strong balance sheet in which they have a massive cash position that completely outweighs the debt, and their debt isn't that much anyway. But the concern that has dropped the share price is obviously whether they can reverse this trend. And negative free cash flow isn't a great thing to have either. The red flag that I can see here, which makes it a lot riskier, is the fact that this year they've grown their dividend by 30%. And this is despite their earnings dropping massively. And so whilst they have the cash position available and they can pay it, they have to be very confident on the outlook for the future. And investors maybe aren't as confident. And if they do become unprofitable and this is a trend, then that dividend is very likely at risk. But this is also the 10th consecutive year that they have grown their dividend by 30% or more. So that is some really incredible growth. And obviously, if they continue in the future, the opportunity is here that not only would you be getting a fantastic growth stock, but this dividend could be growing at 30% each year for the next 20 years, completely outrivaling anyone else in the UK market. The company is named Avon Rubber, and I don't mean the beauty magazine that had made every single parent a reseller of makeup products, but rather a company that provides respiratory protection for the military, law enforcement, and also fire brigades. The opportunity I see here is that they can reverse this negative earnings trend. Obviously, they were likely hard hit by the pandemic. They reverse this. They get their earnings back up to a higher amount. They continue growing upon it consistently, which I guess they really haven't done over the last few years. Then that dividend becomes sustainable and you could get a strong yield on cost. That means that over the longer term investment horizon, that you could really benefit and have not only good capital appreciation, but a strong dividend yield. If you're interested in my Rolls-Royce stock analysis, click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great day.